Welcome to Investment Basics, an educational program provided by BCU Wealth Advisors, LLC, and sponsored by your credit union. In collaboration with your employer, Boston Scientific, this program is one of a series of BCU financial programs and offerings that can earn you incentive points upon your successful completion and will be considered within the on-site activity category through the All Healthy Me Wellness Program. Investing for the future is an essential piece of your financial well-being. To help you get comfortable with the idea of investing, today we're going to cover the basics of investment planning, including general concepts, investment options, and investment strategies. Many people want to invest for their future, whether for retirement, to send their kids to college, or to reach another long-term goal. However, many people don't invest because they don't think they have the money. To make sure you have the funds to invest toward your goals, first consider some basic money management strategies. The first step is to set some goals. What do you want your money to do for you long term? When you know what you want, it's easier to find the motivation to get there. Next, look at your income and expenses. If your expenses exceed your income each month, there won't be anything available to put toward your goals. Work with everyone in your household to review all your sources of income and whether there are ways to increase the amount of money flowing in. Then look at your accounts and spending history to see where you might be able to make some changes to free up cash toward your goals. Once you've found the cash in your budget, you'll better your chances of sticking to the savings plan by paving yourself first. Whether the money is deducted from your paycheck or automatically withdrawn from your checking account. Making it automatic makes it easier. Now, on to investing. Some people associate investing with speculating, gambling on the volatile or uncertain value of assets, hoping for high returns. An example of this approach would be trying to time the market to make a quick profit. Others see investing as more of a long-term, methodical effort to save for the future. In fact, investing is a little bit of both. All investing involves a certain amount of risk, including the potential loss of principal, the money you put into the investment. After all, there's no ironclad guarantee that any particular investment strategy will be successful. On the other hand, investing also involves the potential growth of your money over time. The wise approach is consider investing a carefully planned and prepared approach to managing and accumulating money. Investment planning is about discipline and patience, but it doesn't have to be difficult. One important issue to consider when investing is inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. According to the U.S. Department of Labor, the average annual rate of inflation since 1914 has been about 3%. This means that 3% annual inflation, something that costs $100 today, would cost $181 in 20 years. Why does this matter? Because it means your money is worth less over time. Let's say you have $200,000 stashed in your mattress. Assuming a 3% annual inflation rate, that $200,000 will buy you just over $108,000 worth of goods and services in 20 years, and less than $60,000 in purchasing power in 40 years. So if your investments aren't keeping pace with inflation, you're actually losing purchasing power each year. It also means that the real rate of return on your investments may be less than you think, if you're not considering inflation. While inflation reduces the real value of your investments over time, compounding interest has the opposite effect. The way it works is pretty simple. The funds in your savings account, for example, earn interest, and that interest is added to your account balance. The next time interest is calculated, it's based on the increased value of your account. In effect, you earn interest on your interest. Say you invest $5,000 a year for 30 years. After 30 years, you will have invested a total of $150,000. However, assuming your funds grow at exactly 6% each year, because of compounding, after 30 years, you will have over $395,000. The rule of 72 is a quick way to help you estimate how long it will take for an investment to double in value. Through compounding, divide the number of 72 by the rate at which these investments will increase in value. The result is the number of years that it will take the investment to double. For example, if the expected annual rate of return on an investment is 3%, it should take about 24 years for the investment to double in value, because 72 divided by 3 is 24. You can also use the rule of 72 to estimate the rate of interest you need to double your investment in a given number of years. Just divide 72 by the number of years. For example, in order for an investment to double in value in 4 years, you would need an annual return of 18%. The sooner you start investing, the more time your investments have for potential growth. For example, invest $3,000 at the end of each year, starting when you're 20 years old, and you will have accumulated almost $680,000 by age 66, assuming a 6% annual rate of return and no tax. If you wait until age 35 and start investing $3,000 annually, under the same circumstances, you'll accumulate only about $254,000. And in the same scenario, if you wait until 45, you'll accumulate only about $120,000 by the time you're 66 years old. It's never too late, so don't be discouraged if you haven't started saving yet. Just remember that getting started today will pay off in the long run. While you've likely decided what you want your money to do for you, an important consideration is your timeline. Generally speaking, the longer your time horizon, the more aggressive you may want to invest. Put it another way, investments that carry more risk tend to also offer a greater potential for return, making them more appropriate for those with long-term investment horizons. Why is this the case? It's because the longer the investment horizon, the more time you'll have to recover from any investment losses. The world of investing is very subjective. The investment plan that's right for you depends largely upon the level of comfort that you have when it comes to risk. You can't completely avoid risk when it comes to investing, but you can manage it. There are two aspects of risk tolerance to consider. The first is the capacity of your investment plan itself to absorb losses. This can be quantified based on historical returns and time horizons. The second is your personal comfort level with risk. This is more of an emotional measure and depends on many factors, including your objectives, life stage, personality, and investment experience. Some investors are comfortable with a high degree of risk, while others can tolerate only minimal risk. Your individual risk tolerance is an important factor in deciding which individual investments are appropriate for you, as well as how your investment dollars should be allocated among different investment classes. When it comes to investing, there's a direct relationship between risk and return. In general, as the potential for return increases, so does the level of risk. Or stated another way, the less risk an investment has, generally speaking, the lower the potential for return. This is known as the risk-return trade-off. The key is to try to maximize returns at a level of risk that you're comfortable with. There are several general categories of investments to choose from and countless specific investment options within each. The first category we'll explore is the most conservative. Cash alternatives are relatively low risk, short-term, and generally fairly liquid. In other words, you can convert them to cash quickly if needed. You might use cash alternatives to provide you with relative stability, to maintain a ready source of cash for emergencies, or to serve as a temporary parking place for assets until you decide where to put your money long term. A few examples of cash alternatives include certificates of deposit, money market deposit accounts, money market mutual funds, and U.S. Treasury bills, also known as T-bills. Each option offers different rates of return and varying levels of liquidity. The benefits of investing in cash alternatives are that you receive reliable, predictable earnings through interest and maintain an easily tapped source of funds with little risk to your principal investment. The big trade-off here, though, is that the return you receive on these investments is relatively low, compared to the potential return offered by other investment options. In fact, it's possible that the return on these investments will not keep up with inflation. If that's the case, you'll actually lose purchasing power over time. The next investment category is bonds. These are essentially loans, which is why they are called debt instruments. You, the investor, lend money to a government or corporation. The interest rate or coupon rate, which can be fixed or floating, is set in advance, and interest payments are generally paid twice a year. Bonds are issued in denominations as low as $1,000. In addition to a set interest rate, the maturity date is fixed, ranging from 1 to 30 years. However, bonds don't need to be held until they mature. Once issued, they can be traded among investors like any other type of security. Because you can buy or sell bonds in the open market, they can fluctuate in price, selling at, above, or below their fair face value. If interest rates rise, new bonds and investment options are offered with higher interest rates, and existing bonds with lower fixed interest rates become less appealing. So when interest rates rise, existing bonds generally decrease in value. In contrast, when interest rates fall, existing bonds generally increase in value. Generally, The longer a bond's duration to maturity, the more volatile its price swings. The most common types of bonds include U.S. government securities, agency bonds, municipal bonds, and corporate bonds. U.S. government securities are backed by the full faith and credit of the United States government and therefore carry minimal risk. Municipal bonds are issued by local governments of states, cities, or towns. Specific authorities like a state transportation authority may also issue bonds. Corporate bonds are issued by private companies. The volatility of these bonds depends upon the companies that issue them and can range from very stable to highly volatile, such as so-called high yield or junk bonds. Some corporate bonds are convertible and can be exchanged for shares of the company stock. You can also purchase zero coupon bonds that are issued at a discount, below face value. No interest is paid on these, but at maturity you receive the face value of the bond. For example, you might pay $600 for a 5-year, $1,000 zero coupon bond. At the end of 5 years, you would receive $1,000. Bonds aren't as safe as cash alternatives, nor are they as exciting as stocks or commodities, but they're an important component of most investment portfolios. They can provide a steady and predictable stream of income through interest payments for as long as you hold them. Additionally, the income from interest payments is typically higher than for cash alternatives. While riskier than cash alternatives, bonds are generally considered fairly low-risk investments. Because bonds are legal debt obligations, corporations must pay interest to bondholders before paying dividends to shareholders. However, all bonds carry some risk, and some bonds, like high-yield bonds, carry a great deal of risk. With a bond, you can lose money if the issuer fails to make interest payments or is unable to repay principal. Bonds can also lose market value if the issuer begins having financial difficulties. This type of risk is associated more with corporate bonds and less with treasury securities, since they are backed by the government. A great thing about bonds is that they can help diversify your investment holdings. Bond values tend to move in the opposite direction of the stock market. So by holding both bonds and stocks in a portfolio, you might be able to offset losses in one asset category with gains in another asset category. The third major category of investments is stocks. When you buy a company stock, you're purchasing a share of ownership in that business. The greater the number of shares you own, the higher the percentage of ownership you have in that company. Your percentage of ownership in a company also represents your share of the risk taken and profits generated by the company. If the company does well, your share of the total earnings will be proportionate to how much of the company's stock you own. The flip side, of course, is that your share of any loss will be similarly proportionate to your percentage of ownership. Depending on the company and the types of shares you own, stock ownership may carry other benefits as well. You may be entitled to dividend payments, which you can generally receive either in cash or additional shares, capital gains payouts, and other corporate privileges. For example, common stockholders have the right to vote for candidates for the board of directors and on other important issues. In addition to dividends, most potential money to be made from stocks is through selling your shares. If the value of the company's stock has increased since you purchased it, you will make a profit. Of course, if the value of the stock has declined, you'll lose money if you sell. Overall, stocks offer a greater potential for returns than bonds or cash alternatives, especially over the long term. On the downside, if the company you invest in performs poorly, that may result in your shares losing value. In fact, your shares can lose value simply because the stock market is volatile and has experienced sharp declines in the past. This volatility means that your risk of losing principal is greater with stock than it is with bonds and cash alternatives. It also means that stock may not be appropriate for short-term investment timelines, unless you have a high tolerance for risk. Mutual funds represent another way to invest in stocks, bonds, or cash alternatives. The principle behind a mutual fund is quite simple. Your money is pooled along with the money of other investors into a fund, which then invests in certain securities according to a stated investment strategy. The fund is managed by a fund manager who reports to a board of directors. By investing in the fund, you own a piece of the total portfolio, which could include anywhere from a few dozen to hundreds of securities. This provides you with both a convenient way to obtain professional money management and instant diversification that could be more difficult and expensive to achieve on your own. Mutual funds are commonly named and classified according to their investment style or objective. For example, money market mutual funds invest solely in cash alternatives. There are also bond funds and stock funds. Funds that invest in both bonds and stock are often called balanced funds. In fact, there are mutual funds that fit all along the risk-return spectrum. Although the name of a mutual fund sometimes offers insight into the investment style and objective, don't rely on the name alone to determine whether a particular fund is what you want. You should read a fund's prospectus before you consider investing. Mutual funds offer quite a few advantages to investors. First, they provide diversification within the investment. Most mutual funds own dozens or even hundreds of securities. Managers often spread fund assets over more than one industry or even more than one type of investment. Though diversification alone can't guarantee a profit or insure against a loss, holding many different securities reduces the impact of problems with a single individual security. If some of the fund's holdings perform poorly, they may be offset by others doing well. Next, they are professionally managed. The fund's manager analyzes hundreds of securities and makes decisions on what and when to buy and sell. Another benefit to mutual funds is that you can get in with a small investment amount. And if you need to get cash out of the fund, you can do so by contacting the fund company. On the other hand, mutual funds are not guaranteed. The price of mutual fund shares can change daily, and you'll receive the current value of your shares when you sell. This may be more or less than what you paid in. In addition, because investors in a mutual fund can withdraw their funds at any time, mutual funds tend to keep an amount of portfolio dollars in cash alternatives, which, as we have already covered, have a low rate of return. Finally, all mutual funds have expenses that investors must pay for. These include sales charges and the annual operating expenses of running the fund. You can find out about these fees, usually calculated as an expense ratio, in the mutual fund's prospectus. The higher the expense ratio, the more likely the fund's return will be lower than a similar fund with lower expenses. Like a mutual fund, an exchange-traded fund pools your money with the money of other investors and invests in a collection of securities. However, unlike actively managed mutual funds, exchange-traded funds typically select investments according to a specific index, for example, the S&P 500. The fund's investment choices typically don't change unless the index itself changes. That passive management style and relatively infrequent trading can help reduce the fund's costs. While these funds are a way to balance risk and return, so are some other investment strategies. Asset allocation is a strategy that takes into account your comfort level with risk, the amount of time you have to invest, and your personal financial goals. For example, a person with a long timeline to invest for retirement who is not risk averse may have a portfolio with a large portion of stocks, with just a small number of bonds or cash equivalent investments. A person getting closer to their financial goal, perhaps just several years from retirement, may instead choose to have fewer stocks and to minimize volatility in their portfolio and focus more on bonds and cash equivalents. The key is to remember to adjust the portfolio as your goals and timeline change. Another risk management strategy is dollar cost averaging. This is the process of investing consistently over time, no matter what's happening with the individual investments in the portfolio. When the price of the shares are low, you buy more of them. When they are higher, you buy fewer. The idea is that ultimately the growth of the investments provides a better return than you would find by chasing investments on their way up or down. While some people have made a fortune trading individual investments and timing how they buy and sell them, many others have lost a significant amount of money by doing so. One of the great things about investing is that you can do it with any amount of money and find a strategy to meet many goals and timelines. By starting today, you will begin taking steps toward long-term financial wellness. Finally, be sure to take advantage of the tools and support available to you. BCU Wealth Advisors, LLC, and your credit union, BCU, are committed to helping you achieve financial well-being. Through complimentary educational services, as well as financial planning and wealth management services, your credit union can help you set and achieve your financial goals now and in the long term. Boston Scientific wants to help you to understand your financial picture better, and that is why they are collaborating with BCU in this partnership. Now that you have completed the video, go to this link to claim your BSC incentive points. Next steps regarding the incentive will be sent to the email address you provide.